In this video, I want to discuss why companies stay private and why not go public. And it isn't always a black and white answer, but let's look at some of the different issues that companies face when they go public. So first of all, you have a huge compliance and registration burden. That means you have to comply with lots of rules. You may have to have audited financials, things like this. And if you're private, you don't have that burden. Also, when you're a public company, there are certain disclosure rules that it's not only about having audited financials, you must disclose certain things about your business. So if you do something that you wouldn't necessarily like the world to know about, then you can stay private. And there's no reason that a company can't stay private forever. One of the largest construction companies in the world, Bechtel, is a private company. It's been family run since its inception. And it is one of the largest, or it is the largest, depending on how you measure it, private contractors in the world. They build bridges and airports and hotels and things like this. And they've never discussed going public and probably never will. So companies don't have to go public. Now, traditionally in the 1990s, well, I say that because that's my time, but even before that, since post-World War II, companies that would go public would usually do so to raise capital in public stock markets. And so if a company is private and they don't need capital, they have to weigh the benefits versus the costs of going public. And plus, just because you go public, that doesn't guarantee that you're going to get money. Many new issues fail. So they evaluate all these things, and that's why we've seen a lot of companies go public, especially during the excitement of the last 5 years, Airbnb and Uber and companies like this and many others, Palantir. But not every company has chosen to go public. And I think the best example other than SpaceX is Epic Games. Epic Games is a huge gaming company. And meanwhile, you've had Roblox go public and a lot of public companies make games. So it's not, I think, a black and white issue in the case of Epic Games. There may be some other reasons why they stay private, but it works for them and they've chosen to go that path, and for whatever reason it works. So I think it really depends on the circumstances. I don't think there's kind of, it's better to be private or it's better to be public. It depends on a lot of things. It depends on what is your product, is it going to benefit you to have the exposure of being a publicly traded company, and so on and so forth. Of course, if you're public and things don't go well, you have issues that you have short sellers in public markets. You've got situations where you can be delisted if you don't maintain a certain share price or certain financial metrics. You can be delisted, so you have to maintain that. You can have some competitor launch a negative news campaign that can directly impact the stock, and there's really nothing you can do about it. The Overstock CEO, Patrick Byrne, used to complain about how some Wall Street banks would manipulate the news and the short sellers in order to drop down the value of their competitors or people that they didn't like, or possibly for some reason they would make money by your company losing. You can't really do that in private markets because it's not liquid enough that you can do other things, but a lot of these negative strategies where they try to have a negative outcome, they just wouldn't work in private markets. So there's a level of protection there as well, that it's not public, so you don't have the obligation to participate in a lot of this. And there's been some other claims of monopolistic behavior by the big banks, that when you go public, you have to kind of change your business model, and maybe you're not willing to compromise to their requests. So those are all some reasons to stay private. Of course, many companies choose the path of IPO and they go public, and it's also a way to get your name out there. So that's one benefit, is there's only 5,000 or so publicly traded companies, so it's a lot. If you include the pink sheets and OTC, it's a lot more, but there's not like millions, right? There's only so many, and even out of those 5,000 or 6,000, you've got a lot of shells and just micro caps that don't do much. But really the big names, it's not too many. And even like the mid to large cap companies, there's not so many. So I mean, there's quite a number of private unicorns, which is 1 billion valuation or more. And it's changed a lot over the last 20 years, and especially over the last 10 years. Companies have gone public, I would say, less in total. But, of course, many companies still do want to go public. But the dynamic has changed a lot. So if you're big and successful and you're private, you may just want to stay private for a while. So the motivating factors have changed in a way that it's not just like an assumption that your exit strategy is to go public. Your exit may be to hit a certain milestone or an acquisition or a secondary tender process that you're going to do where you're cashing out of your shares but you're staying private. So an IPO is not always the end goal anymore. And that's why I wanted to make this video, because in private markets, we always assume the IPO is the end game, but not necessarily. Maybe the end game is something else. Either way, it doesn't really matter. That's a strategy discussion. As long as the company is doing well and the share price is going up, investors are making money. Private companies typically don't pay dividends, but they do have the appreciation of stock. And because there's no custody of the shares, you're not paying taxes every year on capital gains or something like this. You're just appreciating the growth. And then when you sell, then that's when you're going to have a tax event. Of course, there's this interesting thing for seed investors called Qubit you can look into, where if you invest in a seed company, it has to be less than a certain valuation. A large part, or I want to say all of those gains, you have to meet all the criteria, but those gains are non-taxable. It's called Qubit. So as we've discussed, there are some benefits and risks of both staying private and going public, and it's really not only up to the company to decide, but each company has different set of circumstances. So each team needs to decide what's best for them. So I wouldn't bet on any company necessarily going IPO or not, whether that company is Epic Games, SpaceX, or companies that look like they're going IPO like Klarna. You never know. You never know when things can get pushed back. And then you've got the situation where Twitter is public and it's taken private. So there you go. It's a more dynamic world than it was even 10 years ago, and it's always getting more and more complex. And capital markets always evolve to meet that need. And private markets are very elastic. They're maybe not liquid like public markets, but they are elastic. They have a lot of dynamics that meet the needs of this specific type of situation. And many of these companies have very healthy secondary markets. Companies can get the capital that they need. Shareholders can get the liquidity they need. And that's managed mostly by broker-dealers like Venture Capital Cross and many others. And those needs are going to be changing over time. So I don't see private markets going away. I don't see spreads going to zero or some kind of end game scenario. I think it'll just continue evolving. I think they'll get more efficient over time. And I think it's going to extend down to the earlier stages. So I think we'll see more of a blending of the Reg CF market, the crowdfunding market, with the Reg D and the late stage secondaries market. So I think in the future, there'll be less obvious differences of these three markets like there is now. Like now you've got secondaries and you've got crowdfunding and you've got primary financing rounds and that you've got the institutional market and the retail market, and they're just these fragmented markets. I think those will blend together more, but you're not going to see private markets go away or companies go public earlier or later, or that the need for brokers is going to go away. I think if anything, the need for brokers is going to increase over time as markets get more complex. And you've got a lot of differences between foreign markets and US markets. A lot of companies come to the US just to access markets here, and that's a good thing for US, but then you've got situations like Stripe was started in Ireland and then came to the US. Skype was pretty much a European thing, but was finally bought by Microsoft in the US. So I think the cross-border VC is going to be one element that comes out of left field and really changes markets, because the world is shrinking. The world is flat in an economic sense, like Thomas Friedman said, I believe. And what that means is Ireland is currently a different country, and the EU has different rules and different currency and everything. And I think in the future that will become less of an issue. When you've got currency companies like Revolut who are tackling this cross-border payments issue, and there's many others, but Revolut is a great example because they're basically in the FX business. The currencies drive the international trade. So I think that VC markets are going to be more accessible, and there'll be less friction in between borders. In other words, years from now, we might be looking at startups in Mexico or startups in Thailand a lot easier than we do today. Like now, it's pretty much, if it's not in the US or in the UK or in a major G8 nation, we're not going to look at that. We're not going to look at microfinancing in Africa, whereas in the future, why not? If there's a business opportunity in Africa, it should be no different than providing money to your local mom and pop shop that's trying to open a restaurant. Same with secondaries and big deals. Big deals shouldn't be exclusive to certain U.S. companies, available through certain U.S. broker-dealers. So I think that private markets will evolve in a very dynamic way that's going to adapt to the market's needs more than anything. I don't see anything going away. Everyone thought Carta was going to take over private markets and that no other player would exist. And now Carta X doesn't exist anymore, and Carta is focused on what they do best, which is being a great transfer agent and a fund administrator. And they do a great job at that. So congrats to Carta for avoiding the noise and sticking to your core. Great job. And I think we're going to see more vendors have more specific focuses. So I think this is all good. I'm very positive on markets now with it's 11/16/2024 as we're making this video. With the new pro-business administration in the White House, it's going to be really good for markets. The Fed's going to start to aggressively cut rates. We're going to see a boom. The next 20 years is going to be the golden age. We're going to see the rollout of technologies that were previously secret that are going to just transform healthcare, transportation, space travel, name it, space mining, computing, food, agriculture, just every sector, manufacturing. We're going to just see massive, rapid paradigm shift. So it's an exciting time to be alive on Earth. It's an exciting time to be an investor. And I think also in the future, people will realize that investing is not only about money. In other words, you have to have a return. They say in Wall Street that you can't make a market if you can't make a buck. And I appreciate this deeply because you have to incentivize economic actors in order to play the game. And you need players in the game to make markets work. But the problem that we've had in the last 100 or so years is you have capital concentrated in a few hands, and those players have then rigged the game, like hedge funds, for example. So hedge funds originally, the economic value argument of why they exist is they create liquidity, they create markets, they make markets basically. Markets can't exist without big firms that have capital to trade. And that's true. But what happened over time is the hedge funds realized they have money, so they have an advantage over people without money, so they could sponsor lobbyists to create Reg NMS and then basically front run retail flow from Robinhood. And then why not just create Robinhood so we know where all the dumb money is trading, so we can trade ahead of it and sell them back the stock they bought 0.01 milliseconds ago at a 0.01 higher price multiplied by 10 trillion transactions, and we've just made $100 billion taking no risk. So that's the problem with where we're at in capitalism. So I think the next evolution is, it's not only about making money. In other words, you have to make money. This is not a socialist view. This is a next generation markets view, which is when you make money, you have to have a winner on the other side. In other words, some of these companies like SpaceX create value where the investors make money, they hire employees, there's real economic value being created. And there's thousands of examples. So I just use that because it's a popular company. Then you have the Soros model, where you have a winner and a loser. So there's always a loser on the other side. Like with the real estate thing, Goldman was shorting the ninja loans of people that they knew at some point people couldn't pay these loans back. So they were encouraging everyone to take these loans. And when the housing market fell apart, this fund, and there were others, but one big fund made just tons of money. That type of, that's not a real trading strategy. That's cheating. You can't rig the game. You can't build an economy out of rigged markets. Let's put it that way. So stock markets, capital markets are good because you're raising money for companies, and those companies are hiring people. They're building things. They're doing things in the real world, not necessarily the physical world, but I mean the real economic world. They're building AI models. They're building a better mousetrap, whatever it may be, inventing things. When you get into the tertiary, the abstract derivative Wall Street trade strategy, they're not creating any value. They're not like buying and selling corn futures and creating liquidity for markets. They're looking at a way to manipulate the system. And I'm not saying arbitrage is bad. I'm saying there has to be a win-win in the trade. So I want to make money, but I want my counterparty to make money too. And only when you have a win-win, you can have capitalism that is sustainable, because the win-lose model is just not sustainable. I'm digressing from the point of this video, but the point is that private markets are going to continue to grow. It's not going to cannibalize itself. It's not going to have a monopoly emerge as the only player. I don't see that at all. I see it as being more dynamic. There's going to be more players, more countries. Regulations are going to probably be more smart. Let's put it that way. It's not going to deregulate, but there are going to be more smart regulations. So this is a great time to invest in private markets and just diversify. That's the best thing to do, diversify. Thank you for watching this video. This is Joseph Gillette Sr. with Venture Capital Cross, and look forward to seeing you in future videos. Have a great day.